Imagine waking up to headlines where Germany, the economic engine that has driven the economic union for decades, is on the brink of an economic downturn.
Germany is in recession. Revised figures for the first quarter show the German economy shrank by 0.3%. That followed another quarter of falling GDP at the end of last year, meeting the criteria for a technical recession.
Really, this was an economy that was hoping they could get away with this winter without a recession, and as we discovered today, not so. The revised down quarter on quarter, minus 0.3% from flatlining. That is quite a, that's not an unsubstantial revision downward.
Well, my friends, this is not a figment of imagination, but a reality that has sent shockwaves through the financial world. On 25th May 2023, Germany's Statistics Office released data showing the contraction in the region's GDP in the first 3 months of the year 2023. It was the second consecutive contraction following the fourth quarter of 2022. And 2 consecutive contractions mark it as a definition of economic recession. So the world's 4th largest economy is officially in recession. But what happened exactly? And does that recession mark the beginning of Europe's collapse? So let's unravel the truth behind Germany's recession and its potential impact on the future of the European economy. So let's get started. Germany, the largest economy in Europe, accounting for about 30% of the region's economic output, has been the powerhouse for decades, pulling the region through one crisis after another. It's the most important trading partner for more than half of the EU's 27 member states, and it is one of the 20 countries that use the euro as a currency, called collectively as Eurozone. The German economy has now entered a recession in early 2023 after household spending in Europe's economic engine succumbed to the pressures of soaring inflation, 1.2% in the first quarter, with shoppers less willing to splash out on food, clothes and furniture. Gross domestic product fell by 0.3% in the first quarter of this year and 0.5% in the fourth quarter of 2022. Even German economists have acknowledged that there is no sign of improvement in the foreseeable future. Additionally, Germany's economic performance has been poorer than that of the United States. In fact, it was already among the last in Europe to return to pre-COVID levels when economies started to rebound after the pandemic. And if we talk about the reasons behind this economic downfall, well, one of Germany's most pressing issues is the unresolved energy crisis. Its industry, which had previously relied on cheap Russian gas, was struck hard last year when Russia launched its ill-fated invasion in February 2022. And so the prices skyrocketed when supplies were cut off. Now, Germany's energy costs are twice as high as those in the US, posing a significant burden on its economy. Another major factor is the decline in manufacturing. Germany is a major exporter, and a lot of its economic growth relies on its manufacturing sector. But this sector has been hit hard in recent years due to the US-China trade war, which has disrupted global supply chains. This decline in productivity can also partly be explained by the aging population and workforce, and slow adaptation to new technologies as well. Additionally, the auto industry, which is a major driver of the German economy, has also been hit hard due to the increased cost of materials and the downturn in consumer demand. Exports of German cars to China fell 24% in the first quarter. Business investment in general has declined in Germany. This is due to the uncertainty about the future of a global economy and concerns about the impact of Brexit. Many businesses are holding back on investment until there is more clarity about the future. Furthermore, Germany's debt levels have risen since the pandemic, and rising interest rates are increasing the cost of Berlin's interest payments, implying that there is less money available to pay for public services. Now let's assess the current state of the German economy, backed by facts and figures. Are there any signs of recovery, or are there further challenges ahead? Well, the euro dropped 0.2% on 25th of May as Germany was confirmed to be in a recession, while the dollar hit a 2-month peak. In fact, according to the IMF, Germany is predicted to be the lowest performer among the world's major economies this year, with production falling by 0.1%. And Germany's GDP growth has been sluggish, and unemployment figures have also climbed, with job losses hitting certain sectors harder than others. Interestingly, the German government is currently significantly decreasing its expenditures. Government consumption expenditures are down by 5% year-on-year, with a majority of the decrease occurring in Q1 2023. This huge reduction in government spending has the potential to further weaken the German GDP. Moreover, the higher inflation and rising borrowing costs have been detrimental to German consumers, contributing to an 8.6% reduction in retail sales in March compared to the same month a year ago, after correcting for inflation. So, all things considered, Germany is at a risk of a long, slow decline. In fact, along with Germany, GDP in Greece, Ireland, Lithuania, Malta and the Netherlands fell quarter on quarter. And while the region's economic recession is a significant concern, it's easy to see why this is giving the rest of Europe the shivers. After all, if its most important member is in trouble, it risks taking the rest of them down with it. And the economists are not optimistic for the coming months. The Eurozone's 20-country GDP declined by 0.1% in the first quarter of the year 2023 compared to the final quarter of 2022, when GDP also fell by 0.1%, revised from a previous figure of 0. And the impact could be significant. Let's take a look at some of the potential effects in Europe. Number 1. Trade. For countries such as the Czech Republic, Poland, Hungary, Romania and Slovakia, Germany is the most important sales market. Germany receives a quarter to a third of all exports from these nations. Exports to Germany produce 2.2% of the EU member states' gross value added. Germany's stagnant economic progress would have a severe influence on its European neighbors. Number 2. Banking sector. Germany has a large banking sector, and a recession could lead to a decline in the value of bank assets. This could have implications for the entire European banking sector. For instance, the economic recession presents a problem for the European Central Bank, which has been on a hawkish path for the last year and just raised its key interest rate to 3.25%. Poor economic performance may limit the ECB's ability to raise interest rates further to combat inflation. Number 3. Migration. Germany has been a destination for migrants from other European countries. Germany had the most immigrants in the European Union in 2020, with over 400,000 people flocking to the country. However, because of rising inflation and unemployment rates, skilled migrants are no longer interested in working in Germany. Number 4. Political instability. A recession in Germany could lead to political instability in the country, which could have implications for the rest of Europe. For instance, all of this economic misery is projected to feed political tensions and opposition to Russian sanctions, forewarning lawmakers that rough months lie ahead. So, this economic recession has far-reaching implications for Europe's economic stability. In fact, Germany's entry into a recession may serve as a warning sign for Europe's struggling economies. Unless Europe finds solutions, a slow decline is likely to persist. It's an opportunity to build resilience, adopt sustainable practices and develop new alliances as we navigate these rough waters. If you find this video informative, give it a thumbs up and share it with others who might be interested. Also, don't forget to subscribe to our channel and turn on notifications for more thought-provoking content. Thank you for watching.